Well, hello everybody, Michael Silva here. We've had ourselves an explosive 11.7% rally in the S&P 500 in a very short period of time, and it feels very familiar. So I'm going to be pointing out all those things that I'm noticing from the prior big 11% spike that we saw over here in March of 2022. You're watching the Stock Market Brief Show. My name is Michael Silva. This is where we navigate the financial markets through the lens of technical and intermarket analysis. Make sure to hit that thumbs up and subscribe to the channel if you haven't done so already. And happy Thanksgiving, everybody. Hope you get to spend some time with some family and friends. Many thanks to the patrons that support my show and my partners, Interactive Brokers. Let's go ahead and get into today's episode. All right, people, welcome back to the show. So, there's been multiple times where we saw large spikes, but the sentiment here feels very similar to the sentiment over here. And I'm going to also point out a lot of technical charts that match up to as well. So we're sitting right here at about 3% under the all-time high right over here. And right when we're over here after a very sharp 11% rally, we were sitting around under about 3% or right around there from the all-time high too as well. You can actually just draw a line across here. You can see we're kind of just in that prior area. And during this 11% rally, we're literally right here coming into April, these were some of the things that were being said on Twitter. They were basically taunting the bears. This is overconfidence spewing out from one-way price actions, stuff like, but they said it was a quote-unquote bear market. Your guru told you to get ready for the bear market. Imagine calling bear market when prices are above the blue line. Literally hilarious. It was a bear market for 3 days into the year. Now it's a slaughterhouse. SPX bullish percent exceeded 75 today, increasing the odds of a bull market continuation in my view. Sorry, bears, SPY and Qs to the moon. Those were all said right here. We're getting some very similar type taunting sentiment on Twitter these days, or X, on this current 11+% rally over here. Actually, what I found funny was this one over here. They said, sorry bears, SPY to the moon right here. And look at what they're saying here. The only bear case left for SPY, market at 52x high, bears double top. They're saying the same thing after this 11% rally, so it's kind of funny. But that's beyond the point. That is more just entertainment. I want to go look at back month versus front month volatility. This has now creeped into above 1.2. So that means back month is 20% higher than front month volatility, as VIX is getting absolutely just obliterated right now. It's just getting pushed down, and it's really making this rally kind of just push higher and higher, or drift higher and higher. But when we reach into this level where the VIX is, very low, and we're sitting at, back month is 20% higher, that has marked topping or parts of consolidation too, I should say, in the market. So for example, right there, here we got all kinds of crazy action, but we did come out, eventually correcting that move. We had over here where it marked a little top. We had over here where it marked a little top over here. So throughout 2022 is a pretty good, got way above there, but that also started that bear market. And we're just moving into that over kind of bot condition here when you look in terms of volatility structure. A couple interesting things here is the Bullish Percent Index. Now, I've showed many of these in the last prior, not yesterday's video, but the one prior, where I went through all different sectors and different indices of this. And I'm just calling it out because the RSI is well into overbought condition on the Bullish Percent Index for the S&P 500. It's right sitting around here at 6240. And, if you go back to when we had that March rally over here, that 11% rally, where were we? Well, we were actually higher, but I just wanted to call it the RSI was in that overbought condition. And you can see that this does oscillate between oversold and overbought. And I always like to look for divergences to form or get in these conditions, right, where they become overbought they could be overbought for a while. But you can see, for example, you get, the Bullish Percent Index, it's reaching really high over here, a higher high, lower high, and then we see this little rip to the downside. We've seen many different bullish divergences where price action went higher. We have a negative divergences right over here where that actually marked the top in 2022. And you can see multiple times throughout history. The most recent bullish divergence was when we had a low and a lower low, while the RSI was giving us a high and a higher low reading. That led to this rally over here. So if you're interested in seeing these charts more frequently, I talk about them here on the videos, but you can also, if you're in the swing trading community over here, you can go into the channel on the Discord. I think, yeah, stock market indicators over here. I have permalinks to the Bullish Percent Index charts that I personally use, or that I look at. So that's one of them. The S&P 500, the S&P Technology Sector Bullish Percent Index. This one is also an overbought condition. So mega cap stocks, and the Bullish Percent Index is rather high. It's above 80. If you look back to when we had that, large rally in March of 2022, we had ourselves a negative divergence forming. You can see that RSI was in that overbought condition too, and that led to a move to the downside. So even over here, I mean, if you go back to the videos I was probably talking about there, I was talking about all these divergences that were happening. The most recent one that we talked about was this bullish divergence. The one prior, we were all over the negative divergences that was forming right over here on this specific chart. Now, if we take a look at some more ways of identifying breadth in the markets, these are various different index products. So the S&P 500 is right here. We have the S&P 100, which are just a larger market cap names, Dow Jones, NASDAQ 100, NASDAQ Composite, and the New York Stock Exchange. And then you see this line going through the screens of all of them. This is identifying the percent of stocks above their 20-day moving average. So when I look at this, down here, almost 90% of the stocks are above the 20-day moving average in the S&P 500. So we're kind of cranking up rather high to a point that we haven't really seen since June of earlier this year. And you can see that when we get stocks that, that are 8+ over 80% above, there's times where it goes into a cool-off period, okay? So right now we're getting into a pretty extended state where we may need to eventually oscillate down here, which I will tell you, there will come a time where we're back down here, which we were down here when we were talking about it. What? We were talking about being an oversold condition. Okay, so now we're really kind of cooking in that overbought condition. A strategy that works very well when I look at this is something called the Holy Grail. If you Google figuring out money, Holy Grail, I made a YouTube short video on that specific strategy from a book from the early 90s called Street Smarts. The name is kind of just a joke, there's no Holy Grail, but it is a very valuable trading strategy in an environment like this. If you're in the swing trading community, I'm probably going to be running the scanner. I've shared the scanner before and posting some of those setups here in the very near future, or on various pullbacks. Now, I want to go into this chart that I posted on Twitter. This is also getting very interesting. So I have up here the 10-year yield. I have the dollar and the S&P 500. Now, if you've been here for a while, you know that I've been talking a lot about how important these two assets are from an intermarket perspective. When these move, it can move other markets and other sectors. And what we've been noticing on the 10% correction of the S&P 500 during this, from up here to down here, well, what was taking place in the dollar and the 10-year yield? They were rising. So we had a rising dollar, rising 10-year yield. And what was the S&P 500 doing? Well, it was going down along with other many sectors and various stocks too. But now, what did we see happen? Well, the S&P 500 rallied incredibly hard and the dollar came off. The 10-year yield, it came off. Okay, so these are backing off. And now I'm calling out currently price action on all three of these assets are coiling up. They're getting very tight, and the dollar is actually breaking currently to the upside here. So I'm calling this out because when we get price action to contract, there's typically an explosive move around the corner. So we may very well be in for a period where we see either the dollar really burst back up, or even the 10-year yield, and that could put pressure back on the S&P 500. Now, it doesn't need to always play out like that, right? We might just move up a little bit or not, or it can expand to the downside, and then we could just drift a little bit higher. But always be aware that if we do get a burst, right, a burst up, maybe the S&P 500 just puts us into a period of consolidation to consolidate more this gigantic move, because there will come a time where it has to pull back and digest. But just be aware that there's contraction taking place. So if these assets start breaking out, history suggests that could be bad for the overall stock market there, the S&P 500. Now, we talked about the 10-year yield also from a bearish perspective. Before I show you that chart, I'll show you the flip side to the 10-year yield. So you have this falling wedge where the TLT, which we pretty much nailed a nice falling wedge over here. But now take a look at the price action. The price action is getting what? It's coiling up. It's getting very, very tight, right? We expanded. Now we're contracting and getting very tight. So what comes after? An expansionary move. That could very well mean that we blast off to the upside. That's always possible. Now, rising wedges are typically bearish, especially when you're in bearish trend, and we are currently a bearish trend, but the trend is trying to recover over here. But just be aware that, if we start breaking down, perhaps that starts the digestion of TLT or potentially a bigger pullback. We don't know quite yet, but just know that if we start breaking down, be careful, because that can be the start of an expansionary type move, just very similar to how we saw this, price action coiled up. Boom, we break out. If you shorted right here, well, you got ran over, like your face ran over, right? It kept on going higher and higher. Now, on the flip side, looking at the 10-year yield, we talked about this head and shoulder, the channel breakdown, and now we're, have a measured move of about 4% to 4.1%. So that's still active, but just be aware that price action's coiling up. It broke down from this channel, but hey, we've seen many times where you get back tests, and then we might say, okay, well, now it might be flagging the back test, and then it might start potentially coming off. But as it stands right now, we're just contracting, and we're currently still breaking down. Now, if we get back above this 4.5% or this neckline, that kind of invalidates this head and shoulders pattern, and you start looking for a back test of the trend line channel that was broken. One thing to call out today was copper was down 1.3%, while the dollar was up on the day, and guess what went higher? The S&P 500. So that's a very subtle divergence there, something to just be aware of. All right, today was obviously a low volume trading day, given that it is going into a holiday tomorrow where the market won't be open, and then Friday, if I remember correctly, is a shortened trading day. If you take a look at the NASDAQ summation index, over here, that purple line, we apply a parabolic SAR. I also made a YouTube short about this specific indicator that's absolutely excellent for finding potential changes in trend in the market. And you can see the parabolic SAR ticked over here just at the beginning of November, and you can see the market, boom, we started really ripping and following through on that potential change in trend there. We had positive divergences forming on the NASDAQ McClellan oscillator around with it. Now what we're seeing is a negative divergence forming on the NASDAQ McClellan oscillator, but this still is in a bullish kind of trend. So if this starts turning around and the parabolic SAR upticks over it, that could identify a potential change in trend or a period of consolidation to be made aware of. The same thing goes here for the NYSE summation index. NYSE summation index clicked over here early November. We saw some follow through on that move as well. And we are getting a negative divergence that's building out on the the NYSE McClellan oscillator. I zoom into it, you can see the high, lower highs where price action is just drifting higher. And it is getting very tight, right? So you can see, right, we had this expansionary move. Now price action's coiling up. Very similar to how we saw it right here. As price action went higher, we coiled up. We had that negative divergence that was building. We went to the downside over here. We had the positive divergence, which gave us insight to this rally and this current one. We're going to stop here, or this will be the last chart, the S&P 500, the SPX on the 15-minute time frame. I updated some gamma exposure levels here. You can see price action's kind of just drifting along the upper weekly expected move. We tagged it, so we are at home base. This is what the market anticipated as risk for the week, and we came and we tagged that level. Going into Friday's trading session, a smaller expected move up 4573 to the upside, 4539 to the downside, and a couple gamma exposure levels to pay attention to. The bigger one to pay attention to is going to be that 4,500, which is known as a gamma flip level. Currently, price action's above the gamma flip, so that means that we are in a positive gamma territory. When we're in a positive gamma territory, they'll sell as the market moves higher, and they'll buy the dips. So it's it's typically lower volatility. But when we get into negative gamma territory, they will buy into the rips and they will sell into the dips, creating much more volatility. That's all I got for you on today's episode, everybody. I hope it helps out, and have a wonderful Thanksgiving.